Everybody. Welcome to the webinar today. And I've named the webinar Unraveling the Mystery of 1031 Exchanges because there's lots of confusion out there. We get people who call and will say, I talked to 3 or 4 people, I got 3 or 4 different answers, and I'm just really confused as to what really matters in the 1031 exchange world, what qualifies, what doesn't, etc. And the reason for that is there's a lot of gray area. The tax code, the regulations, the rulings do not always answer the question, or they partially answer the question. And they leave a lot of answers and facts kind of up in the air. So you get a lot of people who have experience and will give you an opinion, but it sounds like fact. And that's where the confusion comes in, is you're getting 3 or 4 opinions, and they may not necessarily be the answer. There could be a range of answers and things like that. So as we're going through the program today, I'm going to help unravel that mystery. We're going to walk through all the basics, the intermediate level. We're going to get into some advanced levels. I will point out those areas where there's the most confusion and why, and kind of explain the reasons for the confusion and what really matters. And then with that, we'll be in great shape to give you the information you need to help add value to your clients. So again, my name is Bill Exeter. I'm CEO of Exeter 1031 Exchange Services and Exeter Trust Company. And you see the QR code there. If you want, you can scan that and get all my contact information. It also has copies of our brochure, which is what you're looking at now, a guide to 1031 exchanges. That, give or take, is about a 30-page guide that walks you through all the information plus more that we're going to cover today as well. So it's a great tool to kind of get started on learning 1031 exchanges, etc. The other thing to keep in mind is more of a risk management tool for you as agents. Is we're getting more and more people, attorneys, who call and say, my client sold property, was going to reinvest. They're all rentals, they're all investment property, and nobody told them about the 1031 exchange. So now they're going to have to pay tax, and they're reinvesting, and they don't have the cash to pay the tax, etc. And they're always looking for somebody to blame. And people ask, well, whose fault is it? Well, it's the client's fault. The client should have gone to their tax advisor. Their tax advisor should have walk them through what their tax liability would be, and their tax advisor should have recommended a 1031 exchange. But most clients, as we know, don't go to their tax advisor until it's tax filing season. And at that point, the transaction's done. So then when something blows up, they're looking for people to blame, even though the real issue is they didn't seek tax guidance like they should have. So if you're working with a client who has rental, investment, or business use property, the first thing I would do is send them an email and say, you're selling or you're buying rental, investment, or business use property. Have you spoken to your tax advisor? Have you talked to someone about a 1031 exchange? And then when they come back later, try to point the finger, you can say, I emailed you with this information, so that protects you. Second, I'm going to take questions as we go, so please use the chat function. As you have questions, go ahead and post the chat. I will either answer the question as quick as I can, or I'll work it into some of our upcoming slides as we go forward. So having said that, first, for those who have not worked with Exeter 1031 Exchange Services yet, we are a qualified intermediary. The qualified intermediary, we serve all types of 1031 exchanges. We cover all 50 states. We're also one of the few qualified intermediaries that can handle 1031 exchanges of foreign property. So contrary to what you see on the internet and in some brochures where they say you can't exchange foreign property, what they really mean is you can't sell US property and exchange into foreign property, or you can't sell foreign property and exchange into US property. But you can sell foreign property that's held for rental, investment, or business use and do a 1031 exchange by reinvesting in other foreign property. So it does have to be foreign property for other foreign property. And if the sale of that foreign property triggers a US tax consequence, the 1031 exchange might be a solution for them. So keep that in mind. We handle all types of exchanges, all 50 states plus foreign property transactions. Oh, we're one of the few qualified intermediaries that has any type of regulatory guidance or oversight. Our industry is not licensed. They don't have a regulatory body or anything like that, and we wanted to be regulated. So we took a number of years of going down the path of getting the review process and approval process to become our own trust company. So we got Exeter Trust Company licensed by the Wyoming Division of Banking. What that means is now our companies are licensed, regulated, and audited by the Wyoming Division of Banking. We're subject to an annual audit and review. We're subject to strict insurance and bonding and equity capital requirements. So it makes us one of the safest qualified intermediaries out there compared to some of our, or most of our competitors, I should say. We've been doing this a long time. The Exeter Group started in almost 18 years ago. And personally, this is my 38th year doing 1031 exchange administration. So we've got a lot of experience, expertise, and we're really here for you. So we really view ourselves as a support tool to you to help you get business, to help you close deals. We're more consultative, so we can hop on a conference call with you and or with your client or their advisors, et cetera, and kind of help get the transaction completed. And I quickly mentioned Exeter Trust, and then we'll go right into 1031 exchanges. So Exeter Trust is our licensed and regulated entity. It holds all of the client's assets. It also gives us the ability to do self-directed IRAs, custody accounts, specialty holding escrows where a title or escrow company can't handle an escrow because of their regulatory issues, and just basically self-directed type custody accounts. So any of those we'd be happy to chat with. From there, let's go into 1031 exchanges. And again, I'll take questions as we go. So as they come up, let me know. The 1031 exchange, of course, is named after Section 1031 of the tax code. A lot of people don't realize that this is the 101st year anniversary of 1031 exchanges. 1031 exchanges came into being in 1921, so they've been around a long time. I don't have this on the slide deck, but quick mention of the legislative threats to 1031 exchanges. Last year, as you know, the Biden administration was proposing to cap or limit the amount of gain that you could defer through a 1031 exchange. Our goal was to make sure that proposal did not make it into the actual legislative bill. We were successful. It was not included in the legislative bill. But the legislative bill also died in the Senate. So that all kind of went away and became a moot point. The same proposal, the exact same proposal was included in the Biden administration's what they call Green Book back in March of this year. The Green Book is kind of like the administration's wish list, everything they want to have happen for that particular year, what they want to include in the budget, et cetera, but it's not the end all. It's just a proposal. This year, because of all the political stuff going on, there's so much confusion in Washington. Nobody's really worried about that. It's just not going to happen. Here we are in September and nothing has been proposed. It has not been included in any of the legislative bills. So for those of you who are worried about 1031 exchanges, at this point, everything is the same as it was before and we're in smooth sailing. So clients often ask us, and they'll ask you as well, what are the benefits of the 1031 exchange? Why should I use a 1031 exchange? Almost just as important as when should I not use a 1031 exchange? So why don't we start with the benefits first? Of course, it's a tax-deferred strategy. It's not tax-free. A lot of people call them tax-free exchanges, but they're tax-deferred. It keeps deferring the tax into the future. They sell a current property, they do a 1031 exchange, and they defer their taxable gain into the new replacement properties that they acquire. So keep in mind, there's always at least two transactions for each 1031 exchange. They have to sell a relinquished property and they have to buy a replacement property. Many investors will buy 2 or 3 properties and trade up in value. So it's a great way for you as an agent to generate additional business and get out there and focus on 1031s because you're going to have at least 2 transactions, maybe 3 or 4. The end of the day, what it really does for the taxpayer, the client, is that they're selling real estate, and that probably in today's market will trigger a taxable gain. If they had to pay the federal and the state taxes, they're going to write a check for about a third of their profit. That means that that's cash out the door. And it's very difficult to reinvest in other replacement properties if a third of your profit is going out the door in the form of cash. So the 1031 exchange allows them to defer or avoid paying all the federal and state taxes because they're reinvesting. And by doing that, it keeps all of their money in their pocket. Instead of writing a check to the federal and the state government, all of that money remains in their pocket. And that means they can reinvest those funds in additional real estate transactions. So that's really the key. We want to keep the money in their pocket, which gives them the ability to buy more real estate, larger properties. If they're going into multifamily, more units or doors. Bottom line, we want to increase their cash flow. We want to increase their net worth. That's what it's all about. So it really allows them to keep deferring. Now, clients will always ask, well, I'm selling property. I'm going to do a 1031 exchange. What's next? But it's really a wealth building strategy, if you will. It allows them to keep deferring over and over and over. So every time they sell rental or investment property, they're going to do an exchange. They defer the tax into the new replacement properties that they acquire. So they keep deferring. Each time they sell the next property, they do another exchange and they defer. So it's defer, defer, defer. And then when they pass on, whoever they leave the property to will get a step up in cost basis. That gets a little confusing. So as an example, let's say that years ago they bought this property for $100,000. To keep the math simple, let's say today it's worth $1 million. So they've got a $900,000 profit or taxable gain, plus that $100,000 that they originally paid for the property. Some of that is going to be written off or depreciated over time. They depreciate that or write it off on their tax returns over time. So their cost basis is probably something like $50,000 at this point. So they now have a $900,000 taxable gain, and they've got about a $50,000 in depreciation recapture. If they were just to sell and cash out, they'd pay tax on $950,000. But if they continue to exchange, pass on, leave that property to their kids or grandkids or whomever, it doesn't have to be a relative, the person who inherits that property is going to get a step up in cost basis. That means that the new person, the person who inherited the property, their cost basis is stepped up or increased to the fair market value at the date of the death. So the property's gone up in value. It's worth $1 million today. I pass, I leave it to my kids. The kids' cost basis will be increased to the fair market value at the date of my death, which is $1 million. So their cost basis is stepped up or increased to that $1 million level. The property's worth $1 million. Their cost basis is $1 million. Tomorrow they could sell the property for $1 million and pay zero taxes. So it's a great way to take advantage of this, not just on a transaction by transaction basis, but a long-term wealth building strategy. And as an agent, it gives you lots of opportunity to continually sell, buy over time. So they're trading up in values, sizes, number of units, et cetera. Bottom line, they're trading up in cash flow, trading up or increasing their net worth over time. And then when they pass, their kids or whoever inherit that property and pay no taxes. So we have a morbid sense of humor. We call it swap until you drop, and that'll help you remember that whole concept. With that, let's go ahead and get started with the structures and kind of how you put the mechanics to the floor, if you will. So there's really three primary strategies or structures for 1031 exchange transactions. The first one is what people call the forward 1031 exchange. You'll hear it called many things. So for those of us who've been in the business for years and years, when I got into the business in the 80s, it was called a Starker exchange. And that's named after the Starker family, who really fought the IRS in tax court and won. Long story, but they fought the IRS over a 10-year period and then some. And because of those court cases, they actually set the precedent for today's structure. So way back when, you'll call them the starkers. If you're a starker exchange, it's the same thing as a forward 1031 exchange. People call them delayed exchanges or deferred exchanges or just 1031 exchanges. Basically, it means you are selling your relinquished property first. You're then reinvesting and buying your replacement property later or second. So it's a forward exchange, sell and then buy. And that's 97% of our transaction volume. The next is a reverse 1031 exchange. The reverse 1031 exchange allows you to buy first. So you actually buy your new replacement property up front, close on that, and then you have a certain period of time to actually sell your relinquished property and close on that. The benefit of this is it takes a lot of the risk out of the 1031 exchange transaction because you're actually able to close on the purchase first. You know you've got your property. You don't have to worry about whether or not you can or cannot find replacement property. And then you have the 180 days to sell your current asset. In today's market, it takes a lot of the risk out of the 1031 exchange. With a forward 1031 exchange, you're selling first. And because you're selling first, you're triggering your taxable gain. And then the question is, can you find, can you identify, and can you acquire replacement property? And if you're not able to do that, it becomes a taxable transaction. With a reverse exchange, you buy first, you know you've got the property. So it eliminates that risk of what if I can't find replacement property. The downside is they're a lot more complicated, they're more costly, and we'll get into a little bit of those as we go through the program. But with reverse exchanges, a pure reverse exchange means that the client could go out and buy the new property, close escrow, and take title to it, and own both properties at the same time. That's not permitted. That's a pure reverse exchange, but the IRS does not allow that. So holding title to both properties will not work. So the IRS has set up this parking arrangement where we as the qualified intermediary have to go out and acquire and hold, or what they call as park, legal title, typically to the new replacement property. Because we're holding title to the property, that creates all sorts of operational issues. The first one is if there's a lender involved, lenders are typically not going to allow us to do that. Traditional lenders just won't do it. So you have to look at the lender and see if it's a community bank, small community bank, or local regional bank, or hard money, private money lenders, life insurance, things like that. Or if the client's got a really good relationship with their bank, they might be willing to do it. But in a lot of cases, it's an all cash transaction, or we have to look at taking title to the relinquished property that they're attempting to sell, which makes it even more complicated. So that's kind of a quick overview of reverses. Takes the risk out of the 1031 exchange because you've got your new property, but it adds a lot of complexity and costs involved. With an improvement 1031 exchange, it allows you to sell a current property, use the cash proceeds to go out and acquire a new replacement property. You have cash left over, and you use the leftover cash proceeds to improve or build or retrofit the new property you've acquired. Those are also complicated. We have to, again, acquire and hold or park legal title to the new replacement property. So you've got the same lender issues. But if we can do it, then we can take title to the property. The client has the rest of the 180-day period to build out the property, and whatever they can pay for and build out during that 180-day window will count as part of their 1031 exchange. So that was a quick overview of the three different types of structures. Again, the forward exchange is by far the most popular or common. It's about 97% of our transaction volume. Reverse exchanges are just under 3% of the volume, and the improvement 1031 exchanges, because of that time frame limitation, pulling permits, getting the build out done, 6 months is not very long. So you don't see a whole lot of those. So that's much less than 1% of our transaction volume. Okay, with that, let's go ahead and jump into the actual structure, the mechanical structure of putting a 1031 exchange together. This is where you can add a lot of value to your clients because we want to be able to help you help them. And clients get really confused. These are complicated transactions. So the more you can help them through the process, the more they're going to love you. So first off, The 1031 exchange has to be in place before any escrow closes. The reason for that is the purchase and sale agreement is assigned to the qualified intermediary. So you're working with a client, they're going to sell relinquished property. You draft your usual CAR forms for the purchase and sale agreement, et cetera. Those documents are then assigned to the qualified intermediary. We step into their shoes and we become the seller. If that's not put in place and the 1031 exchange documents are not drafted and executed and we're not assigned into the purchase and sale agreement, then we're not acting as the seller. And if the escrow closes without the qualified intermediary serving as the seller, it's a taxable event. There's no way to go back and fix that. Once closing occurs, it's done. For example, we get clients literally weekly call us and say, I closed escrow last week. I just now decided, or I just now found out about a 1031 exchange. I want to do one, but it's too late. Even if they told escrow, don't disperse the money, I'm going to do a 1031 exchange, the fact that escrow closed means they have the right to the proceeds. So even if they tell escrow, don't disperse, they have the right to the funds. It's taxable. There's no way to go back and fix that. So make sure the 1031 exchange is in place. All the documents are drafted. The qualified intermediary has stepped into the shoes of the seller, and then you can close escrow. So the qualified intermediary really drafts the documents to structure the 1031 exchange. They're going to receive and hold the cash proceeds from the sale of the relinquished property, or if it's a reverse 1031 exchange, they're going to receive legal title to the replacement property. And the third one I think is really important. A lot of qualified intermediaries are just processors, and we're in a position where we're more consultative in nature. We've been doing this for a long time. So we really want to be in a position where we can answer questions, sit down and help you, their tax and legal advisors, and the client walk through whatever the challenges are and help solve problems. So that's really the role of the qualified intermediary. The other thing that nobody talks about really is qualified intermediaries hold a lot of money for a lot of clients. How do you protect those? And so this is just a quick overview. There's more issues that you want to look at when you're choosing a qualified intermediary, but I think these are the three most important ones. To us, number one is regulatory. I have been in the business now 38 years. I have seen a lot of qualified intermediaries fail over that 38-year period. I could say almost all of them would have been prevented had they had government oversight. Usually it's a qualified intermediary that's doing something that they really shouldn't do. And if they had an annual audit, they'd probably get caught and then it would be put to a stop. So to me, government or regulatory oversight is critical. That's the number one choice, because that way you have somebody who's looking over the qualified intermediary's shoulders to ensure that they're operating in a safe and sound manner. That's why we wanted to be regulated, and we went down that couple-year path of going through the review and approval process to get our own trust company charter. Number two, people talk about bonding all the time, and they focus on fidelity bond. Fidelity bond is crime insurance. So if the qualified intermediary, steals, misappropriates, embezzles the funds, they're covered for the amount of the bond, and that's important. But most of the problems occur with a qualified intermediary that makes an error or omits something, and it triggers a loss to the client. So you want to make sure they have errors and omissions insurance. You want to make sure that they have fidelity bond coverage. In our case, because we're a financial institution, we also have a financial institution bond package. So those are critical to protect the client in the event of a loss or something like that. And then finally, you want to make sure that the client's funds are held either by a qualified trust account or a qualified escrow account. So in our case, Exeter 1031 Exchange Services is the qualified intermediary, but it never holds the client's cash. Exeter Trust Company serves as trustee of the qualified trust account, and all the client funds are held in a separate, segregated, qualified trust account. So that's critical. It's a long story, but back in 2008, 2009, Land America Financial failed. That included their title company, their escrow company, and their exchange companies, and all their other operations. And the judge ruled that the 1031 exchange funds were corporate funds, not client funds. And they were subject to the bankruptcy creditors, et cetera. And he also said his ruling would have been different had the funds been held in a qualified trust or qualified escrow account. So this is critical so that if something happens to us, bad recession, COVID, whatever it might be, if our company happened to fail, we want to make sure the client funds are held in a qualified trust account to protect the client. So all three of these are the most important things to look at when selecting a qualified intermediary. Okay, this is the most important slide of the deck in terms of the 1031 exchange itself. Every property that the taxpayer sells and the ones that they reinvest in, the replacement properties, have to be held for some type of rental, investment, or business use. And as long as it satisfies one of those three requirements, it will be considered qualified use. So we have to make sure that the properties they sell and buy are all held as qualified use properties. Now that sounds pretty straightforward, but this is the slide where there's the most confusion. And the reason for that is, how do you prove what your intent was? It's not what you actually use the property for. In a lot of cases, it's your intent. If you can prove you intended to hold the property for rental, investment, or business use, you will qualify for 1031 exchange treatment. And a lot of investors, a lot of advisors are hung up on how long have they held title to the property. We get calls all the time where they said, I was told I don't qualify for a 1031 exchange because I only held title to the property for 9 months or 10 months. That's not true. So the most important thing to remember is the tax code, the regulations, and the rulings have no holding period required. Nothing says you have to hold the property for at least X number of days or years. But the easiest way to prove that you intended to hold the property for rental, investment, or business use is to do that. So that's why you get advisors who have opinions like you have to hold it for at least 1 year, or 1 year and a day, or 18 months, or 24 months. And that's when we get those phone calls. I talked to 4 people and I got 4 answers. What's the reason, or what's the issue? The issue is those are just opinions. What it boils down to is, if you get audited, can you prove that you had the intent to hold for rental, investment, or business use? So a couple of comments. Number one, if the investor's in the business of buying real estate and developing it, building it, doing something as a contractor, rehabbing it, etc., or converting it, condo conversions, all of those categories involve them buying the property, doing something to the property, like building it, developing it, rehabbing it, or converting it, and then selling it. Those properties are actually held for sale like inventory in a real estate business. They don't qualify for 1031 exchange treatment. Now, if any of those folks were to buy and then do something to the property, build, rehab, or flip, flipping is obviously the most common term there, or convert to condos and then hold as rental or investment property, it would qualify. So it's the intent that matters. So let me give you a couple of examples there. There's 2 tax court cases. Both are unrelated. Both are developers. Both bought dirt. Both were going to build but didn't build. One held the dirt for 12 years and the other held the dirt for 20 years. So unrelated, but a 12-year holding period and a 20-year holding period. Both ended up selling and never actually building. Both did 1031 exchanges, both got audited, and both were disqualified. The reason is their intent never changed. Their intent was to buy, build, and sell. So it was held for sale. It was not held for investment. So even though they had this 12-year and 20-year holding period, their intent was to buy, build, and sell. Now, somewhere in the middle there, had they said, the market has changed, my business model has changed, I'm going to retire, whatever it might be, and so my intent now has changed so that I'm going to hold this asset or this real estate for some type of rental, investment, or business use. Maybe they're just going to hold it until it appreciates. And when that appreciation hits a certain value they're going to sell, again, that would qualify. And then they would just communicate that. So on their tax return, they would start reporting it as property held for investment, not held for development. On financial statements, mortgage loan applications, emails between them and all their advisors, they talk about holding for investment instead of holding for development. So when they got audited, they could have proved their intent had changed, because intent can change, and that they could document their intent had changed, and they followed through with that on all of the legal docs, the communication, etc. On the flip side, we had one of our clients sell to a 1031 exchange, buy a condo, and then immediately, like I should back up, so bought the condo, and before escrow closed, they did not read the CC&Rs, and that was the problem. Shortly thereafter, a couple days after, read the CC&Rs and quickly found out they were not permitted to rent the property. It had to be owner occupied. So obviously it's not going to satisfy the qualified use requirement, because you can't rent it or hold it for investment or anything like that. So he immediately sold, did another 1031 exchange. As luck would have it, he got audited by the California Franchise Tax Board. And even though he had held the property for just a little over a month, they actually allowed his 1031 exchange to qualify, because he could prove his intent was to hold for rental and investment purposes, but there was a business reason why he couldn't. So again, it's the intent that matters. It's what you can prove under audit. The length of time helps prove intent, but the holding period, the length of time you hold title, does not necessarily mean you do or you do not qualify. It just helps prove intent. So it's only the intent that really matters. And when clients have questions, we'd be happy to jump on a call and look at their fact pattern and see what it might be. Sometimes you've got properties that have been used as a primary residence or a second home or a vacation property for years, decades even, and now they want to do a 1031 exchange. They can stop all the personal use. They can then rent it out, hold it for rental and investment purposes, and after a period of time where they think it's safe to show they did intend to change the usage, it could qualify. So there's all sorts of ways to kind of manage that issue. You just have to be careful and ask the question, does this look like I've truly changed my intent? Can I document that in case I get audited? So let me back up there. So the way I look at it, is if a client sells rental property, they do a 1031 exchange, they buy rental property, they hold it as rental property. A 1-year holding period is probably sufficient. It straddles 2 tax periods. Very solid proof that was their intent. They're not pushing the envelope. They're not taking an aggressive position. But if they are taking an aggressive position, if they're pushing the envelope, for example, maybe they sold rental property, they're going to do a 1031 exchange, they're going to buy replacement property that ultimately they're going to live in, then 1 year may not be sufficient. Under audit, the auditors might think, are you really sure this is what your intent was? So maybe in that case, you might do a 2-year holding period as rental property, which would straddle 3 tax periods on tax returns. Much more solid proof that that was the intent. It boils down to what the client, the investor, is most comfortable with in case they get audited. But again, there's no black and white answer in terms of the holding period. And if you have any questions on the holding period, just go ahead and post that in the chat, and I'd be happy to do some follow-up comments there. The second area that probably gets the most confusion out there is like-kind property. It still amazes me how many people think like-kind means you're selling a condo, you have to buy a condo. You're selling apartments, you have to buy apartments, etc. And that is not true. Like-kind property literally means you are selling real estate, so therefore you have to buy real estate. Anything that qualifies as real estate will satisfy the like-kind property test, as long as you're selling real estate and buying real estate. I should jump in real quick. Before the Tax Reform Act of 2017, you used to be able to do 1031 exchanges on personal property, meaning non-real estate. So we would do exchanges on aircraft, shipping, trucking, animals, livestock, all sorts of things that you wouldn't even think of. The Tax Reform Act of 2017 eliminated all personal property. So at this point, you can only do 1031 exchanges on real estate. So really the only factor is you have to sell U.S. real estate and buy U.S. real estate, or you have to sell foreign real estate and buy foreign real estate. Other than that, real estate is like-kind to real estate. So to kind of take that home a little bit, this is a list of all the various types of real estate you can get into. All of these are considered like kind. So you can sell a single family. You can buy air rights, water rights, mineral rights, oil and gas interests. You wouldn't even think that those would qualify, but most of those under state law are considered to be real estate. So they would qualify as like kind property. So literally, remember, it's real estate for real estate. It also includes fractional ownership. So you could sell a single family house and buy a 10% interest in a either dirt vacant lot. You could buy a 10% interest in a commercial office building, doesn't matter. You could buy a fractional interest in a new property. You could sell a fractional interest. That also includes a Delaware statutory trust, or what they call DST. So with the 10% interest, it's a tenant in common or TIC interest. That means you're on recorded title, you're on the deed, and you get a 10% interest in the actual real estate ownership. With a Delaware statutory trust, you're buying X% interest in the trust. You become a beneficiary in the trust. And let's say you buy a 1% interest in the DST, that means that you're going to buy and you own 1% of everything that is inside that trust. All of this qualifies as like-kind property for 1031 exchange treatment. So it's a very broad definition of what's considered like-kind property. Next, we need to dive into what is not like-kind, because that also helps answer lots of questions. So anything that is 100% personal use, primary residence, second home, vacation property for the family use, things like that, those are not considered qualified use. It's not rental, investment, or business use property. So at that point, it's not going to qualify for 1031 exchange treatment. However, keep in mind, usage can change. So you can always change the usage to rental or investment or business use, and then it could qualify for 1031 exchange treatment. So just kind of keep in mind that I'm going to have an example at the end of the presentation. Will kind of help bring that all together. The one thing I wanted to focus on is entities, and this is where you can help your clients a lot because they get really confused on this topic. So if you own real estate inside of an entity, the investor has to remember or realize they don't own real estate. They own a membership interest, which is probably a partnership interest. They own shares of stock in a corporation. They own a partnership interest in a limited partnership, something like that. They don't own real estate. They own an interest in the entity, and the entity actually owns the real estate. So we have to boil down to who is the real taxpayer in those particular situations. So probably the most common example is an LLC. 3 or 4 or 5 people get together, they form an LLC and say, hey, let's invest together. The LLC goes out and buys real estate. Now they're ready to sell the real estate, and the 3 or 4 or 5 members or partners want to go separate directions. But the problem is they brought people together, they bought into this LLC, they became members. Because there's more than one member, it's now treated as a partnership for tax purposes. So they're actually partners in a partnership, and the partnership as an entity actually owns the real estate. So if the partnership sells the real estate, the partnership, the LLC, has to do the 1031 exchange. I want to go a little deeper there because a lot of information on the internet and a lot of what people tell you is the owner of the relinquished property and the owner of the replacement property have to be the exact same legal title. That is not correct. It has to be the exact same taxpayer. So in this case, the example I just used, you've got an LLC with multiple members. It's a partnership for tax purposes. So the taxpayer is the partnership. That's why the taxpayer, the partnership, has to sell the relinquished property and then buy the replacement property. So it's considered to be the same taxpayer. Usually when we get the phone call, the LLC is not going to stay together. The 3, 4, or 5 members want to go different directions. And there are ways to solve those problems, but we have to look at the goals and objectives of each of the individual members, the LLC as a whole, and then we have to come up with a strategy. So typically we jump on a conference call with the client, with you, and they're probably tax and legal advisors, and then start talking about different solutions that might work to solve these problems. But if you've got a client who owns real estate in an entity that has multiple investors in it, or if it's a corporation, you want to bring it to their attention and say, have you asked yourself, what is your exit strategy? And depending on what their exit strategy is, then they need to meet with their tax and legal advisors to see if the current ownership structure will allow them to do whatever that exit strategy is. If it's a 1031 exchange, what happens typically is 2 or 3 of them want to do a 1031 exchange. The other partners don't want to do an exchange, and that's where it gets complicated. So there are ways to address that, but now's the time to talk about that. There are some exceptions to that. So in a lot of cases, you will have clients that will own the real estate in a single member LLC. A single member LLC is typically a disregarded entity for tax purposes, so it's ignored. So a perfect example of that is you may have a client who has investment property. Maybe it's a small multifamily apartment complex. They own that in an LLC. They are the sole members of that LLC. So it's a single member LLC and disregarded. They sell that, they structure a 1031 exchange. They go to buy replacement property and the lender says, I will not lend to an LLC. You have to take title as an individual. In this case, that's okay because the single member LLC is ignored. It's a disregarded entity. It's treated as if the individual actually owns that real estate. So in this case, let's assume, she's the sole member of that LLC. She has sold, she's treated as the owner for tax purposes. So now she comes over here, she buys the replacement property. The lender says, you have to take title in your name. She was the sole member of the LLC, so she can take title to the replacement property over here, and it's considered to be the same taxpayer. So that's permissible. That's perfectly okay. Living trust, exactly the same thing. A living trust, before anybody has passed on, a living trust is a fully revocable grantor trust. It's ignored for tax purposes. It's treated as if the individuals who are the trustors of the trust actually own the real estate for tax purposes. Even in states like California, where it's a community property state, if you have an LLC with husband and wife as the members, it's still a single member LLC and disregarded entity because California is a community property state. So just check with your legal and tax advisors to make sure it is truly a disregarded entity, but single member LLCs, living trusts, things like that are okay, where you sell in the entity, you buy in the individual name. It's very important to make sure that you're in good shape there. So I just kind of want to bring that up. Next, I think most people are probably familiar with the exchange deadlines, but I want to quickly recap them. So when your sale transaction closes, and let's say it closes today, then tomorrow is day number 1. You have exactly 45 calendar days to identify what you're going to reinvest in or buy as your replacement property. 45 days moves very quickly. It includes weekends. So it's not 45 days plus, it's 45 calendar days. It does not get extended if the 45th day falls on a Saturday or Sunday or holiday. It is still exactly 45 calendar days. And in today's market, it's still a seller's market. It's still kind of challenging out there. So that's where the biggest risk is that 45-day identification window. So there's ways to potentially deal with that. When you go to sell, maybe you can negotiate a long-term escrow, options to extend, to buy you and your client more time to go out and find replacement property. Remember, it helps you as well because it gives you more time to get that second transaction, or third or fourth, depending on what they're going to do. So you want to buy more time to look for that replacement property, or perhaps look at the reverse 1031 exchange. So you've got 45 days to actually identify the replacement property. You can look at backup strategies. So what I've seen is a lot of clients will say, I'm not going to list because I don't know what I'm going to buy. And if I list and sell, and then I can't find replacement properties, I pay tax, and that's going to be very painful. So you might want to look at things like the Delaware Statutory Trust as a backup transaction, backup identification. So you can list property A, property B, and then property C would be the Delaware Statutory Trust. So if property A and B that you and the client are working on fall apart for whatever reason, you've got the Delaware Statutory Trust to kind of save the day. After the 45 days, you've got an additional 135 days to actually close or complete the 1031 exchange, which means close on the acquisition purchases. So it's 45 days to identify, an additional 135 days to complete the exchange, for a total of 180 days. We're coming up on October. It's about a month and a half away. Any sale that closes on or after October 17th means their 180th day lands after April 15th, which is the due date for tax returns. So just make sure the client knows you've got to finish the exchange first and then file your tax return. So they may have to file an extension of their tax return and then file the tax return after the 1031 exchange has been completed. Perfectly okay. They'll have the full 180-day window if they need that, as long as they don't file their final tax return and they go under extension. Identification requirements, this is where you can help them quite a bit. Clients get really confused about the identification requirements. I would say by far the most common used strategy is the 3-property rule. So they'll identify up to 3 properties, property 1, 2, and 3. In a normal market, the reason for this is you identify property 1, which is really the property they want to buy. And property 2 and property 3 are backup properties. So if property 1 falls out of escrow for whatever reason, they can go back and try to acquire property 2 and property 3. Unfortunately, in today's market, property 2 and property 3 are probably long gone. So that's where the risk comes in doing the forward 1031 exchange. But that's really the purpose. Identify 1 and have a 2nd and 3rd as backup. You could certainly have the client identify 3 and they could buy all 3, perfectly okay. Generally, clients are trading up in value. They're going to sell for, let's say, $1 million. They're going to buy for $1.2 million or $1.5 million. So that's why they'll use the 3-property rule. They identify 3 different assets of greater value. However, if a client is selling 1 asset and then going to buy smaller assets, they're probably going to look at the 200% rule. They're going to ignore the 3-property rule. So with the 200% rule, they can identify as many properties as they want, as long as they don't identify more than 200% of what they sold. So a specific example on this, we had a client recently that sold a $4 million asset in Orange County and ended up identifying over 50 single-family properties in Tennessee. And the total of those 50-some properties was not more than $8 million. So they sold for $4 million, 200% would be $8 million. They could identify those 50-some single families as long as it doesn't go over the $8 million limit. And in their case, they actually bought 26 single family homes in Tennessee. So that's a perfect example where you can use the 200% rule, identify a lot more single families to look at, do your due diligence on, and then choose how much you have to buy. He only has to reinvest about $4 million or greater to defer all of his taxes, but it allows you to identify more that you can go through and choose from. The 95% exception you have to be careful with. That means if you identify more than 3 and more than 200%, you're still okay as long as you actually acquire 95% of the value that you identified. Last year, we had a lady who identified 40 single families. We called her and said, you've gone over 3, you're way over 200%. Her response was, don't worry, it's 1 sale contract, 1 closing. I'm buying 40 from 1 seller. They're either going to sell me all and I'm going to close on all, or I'm going to buy none. So she closed on all 40, which is more than 95%. She closed on 100%. Therefore, she qualifies under the 95% exception. So a lot of that gets confusing. So if you have any questions there, I'd be happy to follow up on that. Reinvestment requirements, there's lots of confusion with reinvestment requirements. A lot of investors think all they have to reinvest is their equity, their cash that's coming out of the sale, or they just have to reinvest their capital gain, their taxable gain, or their profit. None of that is true. You have to reinvest at the top level. So as an example, let's say they're selling $1 million asset. You can subtract your routine selling expenses. So that would be your broker's commission, title, escrow, etc. Once you subtract that, your net sale price from a $1 million sale is probably about $950. So $950 would be the magic number. What they buy, whether they buy 1 property or 2 or 3 properties, the total of what they purchase has to be equal to or greater than about $950. So that's the magic number. It's the top level, not the bottom level. They have to reinvest at the top level. The government's really saying, look, you've got this asset worth about 950. Therefore, if you reinvest or stay fully invested at that level, we're going to allow you to defer all your taxes. You also have to reinvest all your equity. So all the cash that comes out of the sale has to be reinvested. Now, you don't have to, and that's one of the areas that gets confusing is stuff on the internet, brochures and things say you have to reinvest your equity. You have to trade equal up in value. You have to reinvest or get a new mortgage for the same amount. Well, they're saying that because most investors want to defer all their taxes. So yes, you have to trade equal up in value. You have to reinvest all your cash equity, but a partial 1031 exchange is perfectly okay. You can trade down in value. People do it on purpose all the time. You could pull cash out. People do that on purpose all the time. You know, in our world, as you know, most people are real estate rich and cash poor. So if they sell for $1 million, maybe they reinvest for 800,000. They've traded down by $200,000. That won't hurt the 1031 exchange, but they're going to pay tax on the $200,000 that they didn't reinvest. So as long as they know they're going to pay some tax, it's not a problem. So some people trade down on purpose because they want less debt on the replacement property. Some people trade down on purpose because they want to pull some cash out and create some liquidity for them. That's okay too. So as long as they know they're going to pay some tax, perfectly okay. If you sell for $1 million and you buy for $1 million, but you get a larger loan so that you end up with cash left over, that's also taxable because they didn't reinvest all of their cash proceeds. So happy to chat with clients when it comes to that. And this is the last slide. And then if there's any follow-up questions, be happy to take those. This is actually a great way for you to do some farming in terms of generating business. So I'm going to use a specific client as an example, it's an unusual example, but it really brings the point home. And it shows you how the changing of use can create opportunities, both for the client and for you as agents to generate more business. So in this particular case, we had a client who, husband and wife, bought property in La Jolla, California, owned it and lived in it as their primary residence for 42 years. They wanted to get out. They were having health issues. They wanted to go back east with their kids and grandkids, et cetera. But their taxable gain was $8 million. So if they sold, they could say, obviously, they lived in it for 2 out of the last 5 years. So they would get $500,000 tax-free, but they're going to get killed on taxes for $7.5 million. The IRS has actually come out with a ruling back in 2005 where you can move out of the house, convert it to investment property or rental property, and then later, as long as you meet all the requirements, when you sell, you can still get the $500,000 tax-free exclusion, and you could do a 1031 exchange and defer the rest of the gain. So what this client did was they moved out of the house, moved back east with their family, rented it for 2 years so they could clearly show, that was 3 tax periods, they could clearly show it was held for rental property. Their usage did in fact change. And then at that point, they still have 1 year left. Remember, to get the $500,000 tax-free exclusion, you have to be able to say, I've lived in it for 2 out of the last 5 years. So as soon as they moved out, that triggered a 3-year window in which they have to do all of this. So they rented it for 2 years. That proves intent to change and hold as rental property. And that leaves them 1 more year to sell and close on the sale of their property, which they did. So in their case, they moved back east. They satisfied that the goal and objective. They rented it for 2 years and then they sold. At that point, they got $500,000 tax-free, and they deferred the other $7.5 million in gain through a 1031 exchange. So there's lots of ways where you can combine the different transactions, the different strategies. You can change usage. So there's a lot of planning opportunities there. In some cases, you can combine a regular forward 1031 exchange into a reverse 1031 exchange, or you can do a reverse 1031 exchange into a forward 1031 exchange. So there's all sorts of advanced structuring capabilities by combining 1031 exchanges. For example, maybe you've got a client who is selling an asset for $1 million. They do a 1031 exchange. The replacement property they find is worth $5 million, and they go, geez, I would really like to sell another property to pay for the balance of that $5 million purchase, but I don't have time. So what we could do is structure an advanced 1031 exchange where we start off with a regular forward exchange. They sell for $1 million. When they go to close on the purchase of their new replacement property, we carve out or allocate $1 million of the purchase price to wrap up the regular forward 1031 exchange. And the balance, the $4 million of excess purchase price, we use to start a brand new reverse 1031 exchange. So now we've got another 45 days to identify a second or third relinquished property that could be sold. And as long as we can close on that within 180 days, we've now funded the entire $5 million purchase. We used the first $1 million in sale proceeds from the forward exchange, and we structured a reverse 1031 exchange for the remaining $4 million. So there's lots of ways to, kind of combine these to solve challenges that you might have. And that was a quick whirlwind tour on 1031 exchange transactions. Hope that was helpful for everybody. Happy to jump on a call later if you have specific transactions or clients or brainstorming that you want to do. Again, we're more consultative, so we're always happy to jump on a call and chat and kind of help walk the investor through whatever their challenge might be. I could be reached in the San Diego office. I'm out of the headquarters. This is the national headquarters here in San Diego. Happy to do that. So thank you everyone for jumping on the webinar with us today. Appreciate your time. And if you have any questions, happy to jump on a call and chat with you. Thank you so much. Take care. Bye-bye.